Now after rights shares, we are coming to one more important topic, which is called bonus issue. Now first of all, what is meant by bonus issue? Now as the name itself suggests, this bonus issue means something which is given to somebody free, right? Bonus is basically an additional benefit, right? Like in the company, when employees get Diwali bonus, it is basically an additional benefit that they get, and for which they don't pay for, right? They don't have to pay any extra compensation, or they don't have to pay any anything in return for getting this bonus. So that is why similarly here in bonus issue also, what is meant is that these shares are offered free to the shareholders, to the existing shareholders. That is why the name, the bonus issue. What are the provisions? What are the regulatory aspects of bonus issue? Now, as per the provisions in Memorandum of Association and Articles of Association, company may issue shares to the existing shareholders for no extra cost. So please remember, there is a difference between rights issue and bonus issue. In case of rights issue, the shareholders get a right. Please remember, there is a difference between rights issue and bonus issue. In case of rights issue, the shareholders get the right of first refusal. And in case if they accept to participate in the further issue of shares, then they have to pay for it. It is not free for them, right? But whereas in case of bonus issue, these bonus shares are given to the existing shareholders free of cost. That is the difference between rights issue and the bonus issue. What is the next provision? Though it increases the number of shares, obviously when the bonus shares are issued to the existing shareholders, obviously these are issued to the existing shareholders only, not to the new shareholders. So when the bonus shares are issued to the existing shareholders, it obviously increases the number of shares for the company, right? But it doesn't change the market value of the company. Why? Because for the simple reason, these bonus shares are given free of cost to the shareholders, and that is why the market value of the company does not change. It changes the share capital of the company, but the market value outside, it doesn't change for the company, because anyway company is not getting extra amount from the shareholders for this bonus issue. So that is one important provision about the bonus issue. And interestingly, what happens is, whenever the bonus issue is given, is offered to the existing shareholders, as I have already mentioned, the number of shares actually goes up. And you all can notice that if the number of shares goes up, obviously it affects the earnings per share of the company, because the profit overall is remaining same divided by the number of shares that is going up, and that is why it results in reduced earnings per share. So whenever, and obviously if the earnings per share go down, obviously it has an impact on the market price per share in the stock exchange. So while offering the bonus issue, company has to consider all these angles before taking the decision of bonus issue. If company doesn't want to basically get its EPS affected, then whatever are the surplus funds, company can decide to issue dividend. What are the conditions for bonus issue? It is not that in any circumstances company is free to issue the bonus share. There are certain conditions which are prescribed. Now and only upon fulfillment of all those conditions, the company is free to offer bonus shares to the existing shareholders. Now what are these conditions? First of all, the shares on which the bonus issue is made are fully paid up. On partly paid up shares, the company is not supposed to issue bonus shares. So suppose, for example, a particular shareholder, out of 10 rupees face value, he has paid only 6 rupees. Then on this share, the company is not supposed to offer further bonus shares to him. Only if the shares are fully paid up, then only the bonus share is allowed on such shares. Next condition, there should be no default in payment of interest on debentures or loans or deposits, and repayment of principal amount of these loans or debentures, similar to the buyback of shares that we saw earlier. If at all the default is persisting, then the company cannot issue bonus shares. First, company has to make good that default, and then only company can go for bonus issue.